We are back with a corner chat. Let's talk business with Mr. Daniel Steinman, and this is your hostess, Elsie Binyani. Last week we spoke about liquidity, Mr. Daniel Steinman.
What is liquidity, Elsie?
We spoke about, liquidity being very high, and today we're focusing on banking liquidity, as the information that we've received this morning that Namibia has 2.9 billion. Is that correct?
That's correct. That is Namibia dollars. Now 2.9 billion Namibia dollar available in the Namibian side of the banking system. So it's available to the commercial banks. That's basically what they've got on hand. But the big figure is the 9.4 billion in assets that they have in the South African banking system. You must understand that Namibian banks, the four large banks, they keep local assets or a local level of liquidity that is adequate for what they need on a daily basis. That is why liquidity is always determined on a daily basis, to make sure that there's enough money in the system for the banks to honor all their obligations to their clients, and this includes making international payments. So you may think, what we need locally is relatively small, but you send one, or NAMDEP at least, they send out one big consignment of diamonds, and quickly you need $1 billion, to finalize that transaction. So banks have to work on a buffer. They have to make provision based on an estimate of what they will need for the day. That's why the figure for Namibian assets in the banking system is 2.9 billion, but where they park the money, and don't laugh, we really say that you park the money. They park it in South African assets. That is cash or near cash, where it can be liquidated fairly quickly if they need to repatriate funds to Namibia on short notice. And that's why the South African figure is 9.4 billion. But don't make the mistake to think it is South African assets. It's not. It is Namibian assets. It belongs to Namibian banks. It is just invested
in South African, parked
in South African assets.
Okay, so Mr. Steinman, Daniel, so the 2.9 billion and also the 9.4 billion is very high, and it's unprecedented.
Record level.
It's unprecedented. So can you maybe explain to us what might be the reason for this? Why is this happening?
Okay.
Why is this money parked and not being used?
This is where we ended last week, and I need to repeat this because it's very important that I don't create an incorrect impression. I don't know. And now I also, in the same breath, I want to say that nobody knows.
Okay.
I'm sure there must be somebody at Bank of Namibia who knows where all this money comes from. But it's not readily available. It's not open information. And I'm speculating that it comes from the capital market, and the capital market is where foreign investors and local investors invest in government bonds. And the reason why I am making that conclusion, now remember, I'm telling you, I can't prove it. I'm drawing conclusions based on certain events, movements that I perceive. And one of them is, and this is the last point I made on that note I gave you, is the so-called long end of the yield curve. Now, without getting too technical, is the bond market consists of instruments. Let me put it this way: the money market is usually defined of short-term instruments, and by short-term we mean really short-term, 3 months, 6 months, 9 months, 1 year. All those borrowings are typically called money market instruments, and they are usually in the form of a treasury bill. So it's like like a promise from the bank, that a promissory note is the popular term. Then you go to the bond market itself, and where the government sells gilts. And this is now longer term, and now you start talking about the capital market. But it is still government debt. It is the government selling its debt to investors in the local market and to investors from abroad, foreign market. So when we look at the mechanism, how this money enters the Namibian financial system, there must be a channel. Now, trade is one. If you import something, you have to pay for it, but that is money leaving the system. Now, when there's excess liquidity or very high liquidity like there's now, it means there's money coming into the system. And if I look at the figures, I mean, they are at record levels. There's not that much money in Namibia, which makes me suspect that the investors are foreign investors. And when I look at the long end of the yield curve, I see that what has been happening since about September last year is what we call convergence. And now you have to understand, for every Namibian bond, and there's a lot of them, from GC23, which is up for redemption this year on the 15th of October, there's basically a bond for every year, 24, 25, 26, and then it carries on to 2030, 2035, 2032, 2045, 2050. And this is what is meant by the long end of the curve. The further you look into the future, meaning the longer the maturity of the bond that the government is selling now. Now, we were penalized quite heavily over the last, since about 2015. And what happened is that the spread, the difference between the Namibian bond and the benchmark South African bond. For every Namibian bond, there's a comparable South African bond.
Okay.
That's why we call it the benchmark bond. It sort of determines the value of the local bond.
Okay.
But the Namibian government debt was quite a bit more expensive than South African government debt. It means that the yields on the Namibian bonds were substantially higher than the yields on the South African benchmark bonds. Does this make sense?
Yeah, it does.
So we had to pay more for our debt. Now that has changed. There's now that long end of the curve. The two run so parallel. You would think it's been plotted on the same plotter. So what has happened is that there is moderation in the capital market. The yields, the local yields, have come down, and that will only happen if money is flowing into the system.
Okay.
And that is why I think the liquidity comes from the capital market. In other words, there's very high interest from foreign investors in Namibian government debt.
Okay. Let's quickly go for a short break, Mr. Daniel, and then when we return, we will, of course, continue this.